look, it's the portion of these bets that are not physically directly hedged with physical that is going to blow up.
Our last episode, you reported the physical gold and silver shortages. Can you update us further on what's happening there?
Yeah, Shane, with the swift nuclear option already fired, gold is most definitely the official's focus. But as we assessed into the paper driven dips, we looked at that last time. We've seen it on last 2 Fridays. All these efforts achieve is actually to incentivize even more sovereign and central bank physical gold buying, let alone the long lines of German, European gold dealers outside the gold dealers everywhere, forcing wholesalers to up their offers to sell. Now, ironically, throwing paper gold at the problem has resulted in an own goal to the West, specifically to the US, trying to batten down a yawning gold window to exchange dollars for gold. So, to make matters even worse, Russia is actively soaking up physical supply, accelerating the process of swapping oil for gold with BRICS countries. Now, while this trade is still very small and unreported, at the margin, this really affects the paper to physical balance. And all the current counterintuitive HFT-driven paper-centric actions achieve is to constructively flush out the hot money, forcing insiders exposed to physical delivery obligations to actually short cover into massive sovereign and central bank demand. Now, this is ultimately constructive, backfilling the paper gaps and allowing the physical support levels to rise. So in other words, while the short-term chart chatter we see is designed to disincentivize gold buying and to suppress the gold price, it'll ultimately backfire.
Now, Andrew, you described the war on gold as a psychological operation, or what is a PSYOP operation? What is this?
Yeah, Shane, that's important. I think anyone can pop onto Wikipedia. That describes the PSYOPs operation reasonably well. I mean, basically, what it says is really what it is. These are operations to convey selected information and indicators to audiences to influence their emotions, motives, and objective reasoning, and ultimately the behavior of governments, organizations, groups, and individuals. So, but what's this doing? All it's doing is actually draining naked long paper speculators, which feeds into the deliverable over-the-counter market, which, as this paper liquidity drains away, raises the offer to sell physical bullion, further bolstering gold and Russian gold reserves. So demand for physical gold is so strong in Russia following sanctions, Russia had to halt central bank gold purchases to accommodate a rush by citizens to buy physical gold. And I think if we had everyone's probably seen the Reuters article, which said, quote, Russian central bank said it would suspend the buying of gold from banks on Tuesday, which was a couple of weeks ago, to meet increased demand from the precious metals from households. Currently, households' demand for buying physical gold in bars has increased, driven by, in particular, by the abolition of value-added tax on these operations, the central bank said in a statement. Wow, that's Reuters. Reuters usually avoid discussing anything that may be in the least bit bullish for gold. And not just take my word for it, try and find something. So further diluting global gold supply, we also have unconfirmed but definitely credible information that the oil for gold trade is underway, which will continue to bolster Russian central bank gold stocks, but also remove gold supply from the global market. And as I say, although it's the thin edge of the wedge right now, the physical shortfall is not priced in. So with global physical demand really off the scale, and last week, major gold producer Kazakhstan banned gold exports to bolster reserves. Now, at a minimum, that removes 500 tons of physical supply into an already tight global market. So really, we're talking about at the margin. This is a huge deal. In fact, it's not even at the margin. This is a huge, big deal. And it's not been priced into long-standing bearish paper bets made long before these supply-demand conditions inverted. So obviously, we're talking about a quadrillion of over-the-counter notional derivative exposure for the global markets. Well, what percentage of that is gold and silver? Quite large. And as we highlighted in our last episode, this sudden unfactored supply shortfall misprices billions of dollars of precious metals derivative bets, relying on a much larger volume of forward supply to cover off these unbacked paper bets, i.e., cover them off with a paper settlement. Not happening. And much like China, Russia's physical gold reserves are assessed to be multiples more than is officially disclosed. Now, both Russia and China, they'll choose their moments to disclose these aggregated holdings, and they will announce these holdings when they employ their nuclear option, not the fear-mongering of a World War III hot war, absolutely not, but nuking the petrodollar, settling vast Russian oil reserves for physical gold. Now, sanctions, I think, have put this 5 to 10 year plan, it was inevitable at some point, I think it's put it right on the front burner. We kind of mentioned it last time. The West has played its hand too early. Now we wait for the BRICS countries to play their hand. And this is the thin end of the wedge that will accelerate the erosion of the dollar's reserve status.